30 years of financialization, where in the developed economies, advanced economies, markets were getting deeper and deeper and deeper, and there was a lot of creation of wealth, of assets. I mean, we all know about the income and wealth inequalities that have grown over the past 30 years. And that money is looking to invest. And the supply of investable assets is inferior to the supply of funds chasing those assets. It's true in the bond market, where people, insurance companies and others are looking for long duration assets. If you talk to the CIO of AIG or the CIO of BlackRock or PIMCO, these guys are looking for long-term assets. There's a shortage of long-term assets, and it's not entirely created by central bank purchases, although that is a significant factor that has exacerbated this. So I think to some degree the same thing is happening in stock markets. At the same time, we have an ETF phenomenon, and a lot of people point to that as something scary, but I don't really think that's the case. I really think what the effect of ETFs is, you have guys now allocating to their Betterment account somewhat blindly, somewhat automatically, and they don't care what the valuation of Apple is. They just know $50 comes out of their bi-weekly paycheck, and it goes in there and it gets allocated automatically. So that tends to raise the equilibrium valuation of the equity market relative to the past. I just think there are a lot of guys that have been bearish for a long time, and they're looking for that one thing that's going to change, and then the whole house of cards will come tumbling down. And it's not that simple. There's a general mismatch between assets that need to be invested and investable assets that can receive those funds.